Welcome back. Tuesday, February 17th, new week. Zack Howard here. A little different presentation today. Tomorrow's video, I'll do a return to bullish bearish trends in the macro notebook. Well, what we're looking at there from a standpoint of current trade setups for now to start the week. The US dollar stronger, 9700 on that DXY, really putting a crimple in the commodities run. Healthy consolidation here. Most of the commodity names like copper, oil, and particularly gold. Don't forget though, China, Asia closed here for a holiday week over there. So a lot of buying into copper, particularly in the commodity space, not going on today to start the U.S. markets. But on to the trend change that seems to be sentiment in equity markets in the U.S., particularly the themes of 2025 around AI, around I guess the hyperscalers, and where markets were really getting ahead of themselves in terms of pricing the reality, what's going to be coming in the years ahead. That's what markets do. They're forward leading indicators trying to price in what the reality is going to be as a constant struggle. But the sentiment has shifted in the last couple of weeks, particularly with something I've been talking about here in my videos for the last couple of months. So much hype into the AI, particularly those hyperscaler mega cap 7. And now the reality is, man, these guys, once very profitable businesses, profitability equals ability to buy back stock, pay dividends, pay down debt, etc. Now the business model of these massive trillion-dollar companies, Microsoft, Amazon, etc., is not only going to use cash flow from their existing business that are very profitable, they're now going to say take on debt in lieu of just using the cash flow to build out this Capec boom. And what we've seen come out of their earnings here now in the last couple of weeks is once these companies say, you know what, we're going to spend 1.2, 1.3x what we previously told the market we were going to spend, the market did not reward that behavior and actually sold off their stock. And now the question keeps coming up, is the build out too big? Are they spending way too much money to outpace what the actual reality is, the return on that investment in the foreseeable future? And to see this sentiment really starting to develop momentum and what that's going to mean for the overall market, these were the leaders. If they become the laggards, what carries the market higher? Rate of change, like I say a lot, is what moves markets. But we're seeing that here at headlines, news stories come out, Bloomberg, Financial Times, etc. There's more and more that's starting to happen. The AI demand, like anything that is in a growing bullish market, it still needs the underlying commodities, materials to support that demand. And one of the biggest materials for this build out is the chip space and is memory. And they are becoming more hard to source the memory side of the business to support all these build out of NVIDIA chips. The stronger the NVIDIA chips become, the more efficient, the more energy dependent they are, the more RAM, the more data are going to use. Chips are going to become more expensive. Can they produce the chips fast enough? To produce the chips fast enough, they're going to need more materials, more the minerals, more that periodic table. So we are seeing a massive increase in memory, primarily manufactured out of South Korea. That is the market where a lot of this RAM, chips, etc. is being made. Is treading the profitability, though, of the underlying business that had to pay now higher price for these RAMs, higher price for the chips. That is in addition to what we're continuing to see in the commodity space to drive up costs. On the right there is the top 10 holdings in the South Korean Kospi Index. Samsung 25% and SK Hynix up 18%. South Korea has really been the biggest benefactor of this AI data center build out hype over the last 12 months. Its exchange has doubled. There we're looking at the ETF EWY, the South Korean index of the Kospi, more than double, like I say, in over a year. So if you're only centered in the US looking at narratives and financial markets, turn on CNBC, you probably hadn't seen this run up in the South Korean stock exchange. South Koreans have also got really used to retail buying, a lot of leverage into their markets. We've talked about the concentration in the U.S. equity markets through those 7 mega cap stocks $55 trillion equity values and how much concentration is embedded in there to get the $55 trillion S&P 500 near 7,000. But the Kospi is even more extreme with just two companies really doing those heavy lifting over the last 12 months, Samsung and SK Hynix. $1 trillion surge in the value through this market's pricing in the future demand for the chips, for the RAM, etc. How sustainable is that? Are we going to get a reconciliation here in the back half of 2026? But like I say, the narrative has changed. Before, when these companies were announcing massive build-outs, now north of $600 billion earmarked to be budgeted for 2026, surpassing what the oil and gas industry is going to spend on Capec for 2026. Shareholders and investors are starting to question, are they going too fast? Is it going to be too much here? Previously, these companies had ability to buy back stock, increase earnings, increase margins, and thus inflate the stock price and thus the equity market. It's probably ready to change, saying this is going to slow down from here. Free cash flow, looking at those 5 big spenders, has rolled over from rate of change standpoint. And that's what I'm saying, is maybe the toppiness is really starting to play out here in that Jenga game with those big companies. We now see all those big companies, except for Google, that's on the verge of bearish trend. They've turned bearish. The flows have stopped accelerating from where they were to. It doesn't mean they're going down. It just means they end growing as fast as they were into those names, and thus the stocks are showing that bearish divergence. The math's getting more challenging. See more and more headlines. Really starts repeating itself. And also now, the Chinese AI data race has really been spurred. And the U.S. is giving them a run for money, but the U.S. cost for running the AI platforms, from what we're seeing out of China, is not near comparable. OpenAI, Microsoft, Gemini, Google, they're throwing trillions at this problem or solution, whatever you look at it. But the Chinese are coming out here saying they're coming out with models, particularly here now in Lunar New Year in China. Alibaba's Qwen 3.5, it is just as efficient for running AI task as Gemini's product, but at just 1/18 the cost. So that's really playing into the expectations of investors, saying we're going to spend all this money, and the Chinese models are always so far out in front. Why are we throwing all this money at the problem? Can we even make up that race, especially when you had the Chinese Communist Party supporting this endeavor with these technology companies in China? That really sets them up for a head start. 61 trillion tokens are run daily by ByteDance, one of the Chinese entities. And Cloud and OpenAI, Sam Altman is still going around to the U.S. government and industry leaders with his handout looking for more money to raise, to try to say, you know what, we're going to be profitable at some point. We can't tell you when, but we're going to keep spending money. Great chart here from Kevin Muir's Macro Tours, showing how the divergence in the actual share price and what the forecast is for the next 12 months of these companies has now diverged. And I think the market's starting to catch up to that. If this becomes a continued theme, how does the market, the S&P, the NASDAQ go higher without a convergence into those hard assets, where I'm saying that's where you should be looking? The metals, the minerals, the periodic table. Great line from Robert Freeland over the last month on this whole theme is the ham sandwich did not come from the fridge when you open it up. And that's what you got to look at inside this whole narrative. It's like, how are they building this thing without massive minerals, massive elements of the periodic table, massive amounts of energy to support it? And that's where the opportunity lies. Just 1% of the S&P 500 is inside the metals and mining, the mineral sector. Even back a few years ago, when you look at the energy component of the S&P to where it stands today, it's just like 1/10. So the real opportunity is not chasing the mega cap hyperscalers higher, is reallocating capital to the trades that haven't caught up to what the reality is: energy, metals, minerals. That's my take on it anyways. Let me know what you think down below. Could use some more feedback on the channel, what you want to see, what you don't. And I really appreciate it if you give me a subscribe button as we continue to try to grow it out. That's what I got for you today. Hope you have a good one. We're back tomorrow with a market update on bullish bearish themes. Thanks.